What's up, guys? Welcome back to another video. If you're new here, my name's BD, and I'm happy to introduce to you all standard deviation plus SMT theory. Okay, if you're familiar with the ICT 2022 model, the market maker model, this is going to give you a way more in-depth and understanding of that model and exactly what's going on within price. And I'm confident in that. So let's go ahead and get right into it. What is it? It is the theory of every leg in price is a market maker model and is started, guided by, and ends by these two concepts. Why is it important? Every leg in price is a market maker model, and it gives you a great understanding of where price reversals, manipulation moves, and such should come from. There is great precision and logic inside this theory, okay? So you're going to actually understand what is happening in price. What else do I need to know coming into this, okay? You need to know how to determine the draw on liquidity. When you can determine the draw on liquidity, this theory is going to help you walk price like a dog to it on the lower time frames, okay? You also need to know my breaker theory and how I determine valid breakers, as they play a huge role in determining where to project off of, as well as how I use midnight price. I will have links below as well to my other videos so that you can go and learn how I use these other PD arrays and such for my theory. Will you be able to trade this right after this video? No. Not right after, I'm going to be honest. It's going to take time of back testing and seeing it in price for yourself to get a good understanding of the theory. But with time and studying and back testing, you will start to see it before it even forms and find great success. So what is STDV? It is short for standard deviations. It's the market moving the distance of the range you're projecting, okay? So one standard deviation is the range you're projecting doubled, okay? So say you're projecting a range of 40 points, okay? One standard deviation away is going to be 80 points, okay? And then two standard deviations away is going to be 120 points, okay? So that is how the standard deviations work. We are projecting ranges. The algorithm works like this, okay? This stuff is so precise because it's ran on an algorithm. It's not buyers and sellers. Okay, so they play a huge role in the development of a market maker model and will give you a great understanding based on where we are within it. The best way to determine where to project off of is to think of a breaker, okay? Breaker to projection, okay? I'm going to go more over this as we get into the chart examples later in the video, but just remember that. Breaker, projection, okay? So 2 to 2.5 and 3.5 to 4 are the two key areas we are going to be focusing on. 2 to 2.5 is where we can see reaccumulation for redistribution in that same direction, or we can see that 2 to 2.5 just cap the range there for that power of 3. 3.5 to 4 is where we typically see the range cap if we get that move to it, okay? And that is typically where we end the market maker model and we are getting out of our position, okay? Once we're hitting that, I am out of my position and I'm just waiting for the next swing to form, the next market maker model to start, okay? There's no reason to be jumping into anything right after we're hitting 3.5 to 4, unless if we're playing the reversal. So right here, this is my standard deviation settings. Take a picture, screenshot it, okay? I have a lot of people that ask me all the time, and I also have people ask me why we use the negative settings, okay? Well, we use the negative settings because the three areas right here that we use to key the fib off of, we're using the 0, 0.5, and the 1, okay? So the 1 is attached to where you're keying the fib. It's a little confusing without a chart example, but you'll understand. Just use the negatives. It works that way. The positive numbers will not work how it's supposed to. So let's get more into it here. So right here, as I was saying, so here's the 1, okay? It is on the area that we're keying within the fib, okay? So if we were trying to project this with positive numbers, it would be off because we're using the 1 to key the fib. Rather than when we're using the negatives here, we're just starting from the 0 and then moving to -1. Okay, so that's this range doubled. And then once again, tripled to get down to -2. Okay, but you can see here inside this image, this is how the standard deviation works and how we're going to be keying it. As you will see, 2 to 2.5 is where we can see that reaccumulation move above an old high, down to 3.5 to 4 standard deviations. Or you also see it work like this, where we'll hit 2 to 2.5, retrace into an FVG, and then we see SMT here. As you would see the NQ reach into an FVG, and then the ES fail to reach into the FVG, and there's the SMT, and then boom, up to 3.5 to 4 standard deviations. So where are we projecting? First, you need to know what you're projecting. Okay, we are projecting power of 3. And this can be any time frame. It's what suits you as the trader and how long you're really going to be in front of the charts or in a trade. Okay, my personal favorites are the 1 hour, 4 hour, and daily power of 3. Okay, I mainly focus with 4 hour and the daily power of 3. But those are my personal favorites. But you can go all the way down to even like a 15-minute power of 3, going down to like a 30-second chart. Okay, it's working on all time frames. How do I know what we are projecting? This is where you learn it's not a pattern and rather time-based. We are projecting manipulation legs. There's many inside a day, and we focus on specific power of 3s, so it gives a better time frame to work inside. Okay, so for example, when we are projecting the manipulation of midnight price, we are projecting the daily range. And when we're projecting the manipulation of the 4 hour open, okay, and the swing inside that 4 hour candle, okay, we're projecting that 4 hour range, that 4 hour power of 3. As you will see though, if we have not completed a market maker model at the end of a 4 hour power of 3, for example, so say the 2 to 2.5 is what caps the range. Okay, we don't break through 2 to 2.5 and we end that 4 hour candle. If we have not completed that market maker model, so if our higher time frame draw on liquidity is still higher, so say for example we're looking for price to reach for a daily FVG and it's still above price and it's lining up with that 3.5 to 4 standard deviations, you're going to see that next 4 hour power of 3 play a huge role in finding that second stage distribution. Okay, and you'll see it carry over into that next 4 hour candle, and that time opening is going to play a huge role in finding that manipulation. Okay, because if you're bullish, for example, and want to see that second stage up, you want to be buying and finding that move below the 4 hour open, and then you're going to be projecting that to the upside. SMT and breakers play a huge role in where you key the fib to project. Okay, so think SMT, breaker, project, SMT, breaker, project. Okay, you're going to see more chart examples later in the video, but be thinking this: SMT, breakers, project. So this is that same image I showed you earlier, but we're going to look at it a little deeper here because I just showed you SMT, breakers, project. Okay, so right here, we want to be seeing SMT right here. So say this is the NQ. Okay, for the ES, we want to see the ES be failing to make this higher high here that the NQ does to create the SMT. Okay. We have SMT, but then we're waiting for what? The breaker. Okay. We don't see the breaker until we see this displacement down below this low, because that's what creates the breaker here. Okay. Because we have the high, low, higher high. We can fiddle around in here. It don't matter. But that displacement below the low is what matters, because then we have our SMT, our breaker, and now we can project because we have the breaker. Okay. So SMT, breaker, projection. Same thing over here. Once we closed above this high and created the bullish breaker, right there, projection. Okay. And here's another thing you're going to notice. These projections, these areas that we're starting new market maker models, these are going to come from areas in a standard deviation from a different market maker model. Okay. So right here, this could be us hitting 2 to 2.5 on the higher time frame, and that reaccumulation move down. This could be the lower time frame move down before we get that redistribution up on the higher time frame to 3.5 to 4. Okay, so when you can really go back and understand what I'm saying there, a light bulb is going to go off. Okay, so what is SMT? SMT is the offset distribution between correlating assets. SMT is at every high and low, so it's crucial for determining the start and end of a market maker model. Price will not expand until SMT is present, so it's very good for determining manipulation moves, which are also known as fake moves. Okay, so how do we determine SMT? SMT is found, for example, if we are bullish and want to see moves higher, we will see SMT at the lows to support the idea of a bottom for a market maker model. Okay. So for this to be created, there needs to be a move lower first. And on this move, you will see the indexes out of sync. Okay. So for example, we will see NQ make a lower low and the ES will fail to make a lower low there. So the ES will make a higher low right there. That's our SMT. And that's what we're looking for out of our PD array of interest and our key spot within the standard deviation to enter off of. Okay. So you're going to notice everything is going to come back to SMT and a key spot within the standard deviation. If you're entering without us at a key spot within the standard deviation, you're doing it wrong. You are doing it wrong. So right here, I'm showing you SMT. So right here at the lows, you want to be having an idea. We're not using SMT by itself. So like I said, if we had a higher time frame draw on liquidity higher, like a daily FVG up here that we are wanting to see the indexes trade to, okay? We're looking for moves lower to find the SMT, okay? And that's exactly what happens here. You can see the NQ comes down, fails to make a lower low here, but look at the ES. The ES makes a lower low. Okay. So right there is the SMT. And then we move up, we form the breaker, same thing with NQ. And then you can project right there off of where we have the breaker. And then you can go back to your NQ and ES charts and tell me if that went up to 3.5 to 4 standard deviations. I know it did. All right, so right here, I'm going to be breaking it down a little deeper for you before we get into the chart examples. Trust me, this is going to help, okay? So here, when we're starting a new market maker model, this is going to be at a key spot within a standard deviation from a different leg, okay? So this move to the downside here, we should be hitting 2 to 2.5 or 3.5 to 4 standard deviations. Okay. And this is also where we're seeing the liquidity taken. We're seeing our key level being hit. Okay. So this could be your 4-hour FVG, whatever it is, 4-hour order block. Okay. And then we're seeing the SMT into it. Okay. This is what's key. SMT taking sell side and hitting the array at 2 to 2.5 or 3.5 to 4 standard deviations. Okay, so then we're anticipating the reversal in a new market maker model to start. Okay, and once that starts, we have our breaker. Once the breaker, we have something to project, okay? Because this is a valid breaker. This goes back to one of my other videos where I've been talking about valid breakers and how I determine them, okay? This right here would be a valid breaker when we're trading out of all the things I was just talking about. So you can see we start moving, we move up to 2 to 2.5 standard deviations. But first, I should mention the draw on liquidity is this daily FVG above. Okay, so we're looking for moves to this daily FVG. So on the way up, we see the move to 2 to 2.5 standard deviations, and we're going to see a reaction here. If we don't, and just rip through 2 to 2.5 standard deviations, that right there is telling you that we are very one-sided, and we're just going to continue up to 3.5 to 4. Okay. And when that happens, I'm typically just not interested to chase price because I know we're very heavy one-sided and I just don't feel like chasing an entry. You could look for a fair value gap entry at that point, but it's just not what suits me and my trading style. I like to find these bigger plays with more confidence behind them in the entries, okay? Logic is everything for me. So at 2 to 2.5, we expect reaccumulation if we have not hit the higher time frame draw on liquidity. Okay. And that's what happens here. Reaccumulation. And then we come out, we take out an old low. All right. And this is also where you're going to be seeing SMT here on the lower time frame. So if you're comparing NQ to ES, the NQ would be taking out this internal low while the ES comes up short. Say just like in here, or it holds an FVG like halfway. Right there is your SMT, and then boom, that's the cue for redistribution up to 3.5 to 4 standard deviations, okay? Now, I'm going to be breaking it down a little more here with time, okay? So say this was the day before, and this is what I was talking about, how the next power of 3 can carry over into the same standard deviations. So right here is midnight price. So this is the beginning of a new day. So this previous day is what took us up to 2 to 2.5. So 2 to 2.5 did cap us for that day. Okay. But then going into the new day now, we see that move up. We finish this power of 3 into 3.5 to 4 standard deviations. And this is also manipulation above midnight price. Okay. So at this time in the night, okay, we're hitting 3.5 to 4 standard deviations. We move straight away from midnight price. We're seeing SMT, and then we're also above the 130 open. Okay. This is a recipe to see us and to know that we're going to see another dip before they reach up into that higher time frame draw. Okay. So right there, you should know that we're going to come back to it later. All right. And we start the internal sell model here. Okay. So we cap the range of this market maker model, and then we see the consolidation here. We start the new market maker model here. Okay. To the downside. And you can see we move straight down. We go back to 2 to 2.5. We'll see that reaccumulation above an old high once again to go lower. They always want to take that liquidity on the reaccumulation, or as I said, it can also be a fair value gap, because a fair value gap is just lower time frame liquidity. All right. So you're always looking for that SMT and liquidity on the reaccumulation. And then we see the move down to 3.5 to 4 standard deviations, where what likely happens? We cap the range, okay? We're not looking to short once we're hitting 3.5 to 4 standard deviations to the downside, all right? And as we're capping the range at 3.5 to 4, this is where we're going to be seeing SMT, okay? SMT is what confirms the reversal, okay? And then this right here is where you should really be interested in looking for that move. And this is also when we're going to see those explosive moves, okay? After we move down 3.5 to 4 standard deviations, okay? And we left a higher time frame draw above, okay? And then we form the breaker. And then once we have a breaker, SMT breaker projection, all right? And then you can see the lower time frame projection here, okay? The 2 to 2.5 is lining up first with internal liquidity, Very nice. And then 3.5 to 4 is lining up right on buy side, which was the previous high, and our higher time frame draw. Okay. So when you have the projections lining up on your targets, all right, it is very high probability and it's not random. Okay. You're going to see more here as we get into the chart examples. And now it is time to dive into the charts. So get ready. As we get into the chart examples here, I thought I would start here with this reference, okay? I'm going to be going over where our entries and exits need to be coming from, okay? Every entry and every exit needs to be coming within a key spot within the standard deviation with SMT, okay? So to form a new swing here, okay? So if we're looking at this swing here, if we're looking to go back to the downside, if we're looking for a short, we want to see price trade up into 3.5 to 4, or if 2 to 2.5 is what's going to cap it, then we need one of these two key spots within the standard deviation to be hit. And then we see SMT, and then that's what flips us over. And then your new targets need to be lining up with old liquidity pools to target. Okay. So every entry and exit comes from within the standard deviation and SMT. Okay. Don't be fooled. There's no reason to chase price if it's outside. Okay. So right here, we're going to be getting into the first example here, and this is going to be a higher time frame example. Okay, don't worry, we're going to be getting into the lower time frame charts and all that later in the video, but let's just go into this first because this is a very clean example here, and it's going to set the stage for exactly what we should be seeing. All right. So in every market maker model, it starts with consolidation and SMT. All right. And that's what we've seen up here. All right. There was SMT here and we had consolidation. All right. This was the beginning of the sell model. And you can see once we put the fib on here because we formed the breaker. All right. 2 to 2.5 was resting at this sell side, 3.5 to 4 right down here at this sell side as well. Okay. And you can see we came down. Where did we reach for first? 2 to 2.5 standard deviations. All right, what happens here? Reaccumulation or reversal? Well, in this case, we had not completed the sell model. We were still expecting lower. We had not seen any major SMT here, okay? So reaccumulation where? Above an old high, takes the internal liquidity, and then boom, right down. It did give one more pop, but eventually we did come down to 3.5 to 4, where we capped the range here. They just gave that. They tapped 3.5 here, came up, took out another high, and then dropped it into 3.5 to 4. And this is where you will see us typically cap the range, okay? You're not blindly looking to buy here, though, okay? You're waiting for the smart money reversal. Price is not going to take off without you. And if it does, so be it that day, man. I'm telling you, it's not going to happen every day. So right here, we consolidate for a little bit once again, because what happens in consolidation? It is the end and beginning of a new market maker model. And that's what happens here. And then we see SMT right here after we got the displacement up. So this displacement created the breaker. And then on the retest, this is where we got SMT with the Dow. Okay. So right here is our SMT, very valid breaker entry. And what happens when you have a breaker? You have a projection. SMT, breaker, projection. All right. And whenever we look at this, we can see 2 to 2.5 standard deviations was lining up right with this buy side liquidity, these equal highs. And then 3.5 to 4 was above the original consolidation. Okay. All-time highs. All right. So this was a very strong draw. You can see it's the original consolidation. Just go look at a picture of the framework for a market maker model and tell me this isn't textbook. All right, and this is exactly what I mean. We're going more in depth into the market maker model. If you've ever heard that clip of ICT talking about if he could only trade one model or one setup for the rest of his life, it would be the second stage distribution in a market maker model. Okay. And that is exactly what this reaccumulation and redistribution up to 3.5 to 4 standard deviations is. Okay, I dug deep to find this. This is what it is. And on the reaccumulation here, when we know the higher time frame draw is still higher, everything is projectable. Okay, and you can go down to the lower time frame, find this breaker here, and we move down 2 to 2.5 standard deviations. And then look at that, we held, and this is where we see SMT. Okay, not only that, what key PD array are we trading into here? Well, if you notice, this displacement up actually created a weekly breaker here. Okay, so then this right here turned into a breaker. So then you can see we came down, tapped into the breaker, 2 to 2.5 standard deviations, SMT, boom, reversal. And then once again, another breaker, boom, continued higher. And then look at this, whenever we have a breaker, we can project. Whoa, mind blowing, right? And look at that. The 2 to 2.5 is lining up right with the 3.5 to 4 of the bigger picture. Okay, when you have projections lining up like this, it is very high probability. And this is exactly what I talk about and mean by a power of 3 can carry over into the next one to complete the next market maker model. Because as you can see here, going into 2024 is when we take all-time highs, okay? So 2023, that year, there was the first AMD, or your first power of 3, okay? And then now we're in 2024, power of 3. All right, and that's what completed the market maker model. So where would we be looking for entries? Well, it's very simple. You're looking for key spots within the standard deviation. And this is a higher time frame chart here. Okay, so longer term longs would have been beautiful down here because we hit 3.5 to 4 standard deviations, capping the range, and then we get our weekly breaker. Okay, and we have multiple targets above. So right here, very valid entry. And then this is actually where I would have been more interested on the reaccumulation. Okay, because this SMT inside the key spot within the standard deviation, that is your confirmation. We are about to distribute up to 3.5 to 4 standard deviations, okay? SMT leads to expansion. We're not going to expand without SMT. And then even here on the reaccumulation, when you know we are reaccumulating on the higher time frame, you can go down to the lower time frames and find those projections to the downside to play, okay? You can be playing these moves. You don't have to always be trading in the direction of the higher time frame, okay? Because there's ways to project exactly where we should go before we turn around. And these are very nice for scalps. I do it sometimes, but for the most part, your better trades are going to come from catching that reaccumulation move for the redistribution up to 3.5 to 4. Okay, so let's get into some other examples here. All right, so inside this example, we're once again going to be combining projections as always, okay? You want to have other projections lining up with the daily projections that you're using, okay? So right here, this was non-farm payroll, all right? Non-farm payroll plays a big role in the monthly manipulation, all right? And right here, we're projecting off the non-farm payroll report, okay? 2 to 2.5 standard deviations. That is what we were hitting here. We were wanting to see some reaccumulation. What happens here? Well, once again, you can project once you have the breaker, because you can see we held that breaker nicely. Very valid breaker to project off of. We move down where? 2 to 2.5 standard deviations, okay? We're taking out these internal lows here. We're trading onto the order block here. And look at this. We see SMT right here, okay? As the NQ fails to make this lower low here, the ES clearly makes a lower low here, all right? So right there, that was telling you the NASDAQ was stronger, okay? The NASDAQ failed to make the lower low, and we were below midnight price at this time. And then you can see from this time, we rallied way above midnight price, okay? So using these things together are so key and can help you a lot. Same thing here. Going into the 17th right here, we have midnight price. All right. So we know we already saw the SMT off the reaccumulation. So what are we expecting here? Redistribution up to 3.5 to 4 standard deviations. Okay. And this is on the bigger picture. So then when we go into intraday times like this, we're going to have lower time frame projections to use, like the manipulation of midnight price and such. Okay. So then from the SMT here, you can see 3.5 to 4 standard deviations. It's lining up right up here, right above 4 standard deviations. Same thing here. Our manipulation of midnight price this day, 2 to 2.5, just below. That's fine because we can see reaccumulation. And then 3.5 to 4. This is what's key. It's lining up right inside 3.5 to 4 of this projection. And then we're also trading up into 3.5 to 4 of the higher time frame projection. Okay. This is also what you got to allow for a move above 4 standard deviations a lot of times on the higher time frame. Okay. Or into the lower time frames, I should say, because a higher time frame wick will be these lower time frame candles extending above it. Okay. And right here, you're probably like, well, we didn't reach this 2 to 2.5 projection to the downside. You're right, because this is a different type of SMT I'm introducing to you. Hold on, let me zoom back out to it. So right here, our projection above midnight price, the manipulation here, we're projecting to the downside. We have 2 to 2.5 standard deviations resting below these lows. But let's look at the ES here. Same exact projection here where we saw SMT at the highs. There was SMT here, so we projected down. Look at that. The ES hits 2 to 2.5. Right there is your standard deviation, SMT. Okay? And then you can see that provided the reversal. We were below midnight price. We saw that 930 manipulation below. Failed to hit it. Gave us the standard deviation SMT. And then once we formed the breaker, it was gone from there. Okay? So you got to realize SMT, breaker, projection. SMT, breaker, projection. All right. And then depending on what you're projecting, if you're projecting the manipulation of midnight price like this, okay, you're projecting more of the whole daily range. And you can see here, all right, we started the 17th here. Here was midnight price manipulated below. We're projecting the manipulation, 3.5 to 4 standard deviation, cap the range for that day. Okay. And then also 3.5 to 4 from the bigger pictures. Okay. So when you can have projections aligning like this and your draw is also in that direction. So if you have a daily FEG, buy side liquidity, whatever else you want to see, it's very high probability. And you're going to start to see this repeat and repeat and repeat. All right. So now as we move into this next example, you have the framework from what happened in the past. We're hitting 3.5 to 4 standard deviations here on the monthly projection. Okay. So I showed you the non-farm payroll projection, and that's what we're hitting up here, 3.5 to 4. And we're going into the end of the month. All right. So we shouldn't be expecting much of an expansion higher anymore. Okay. The meat of the move of the power of 3 for the month is already in. All right. You can't be forcing what's not there. So then here, once we know we're running out of steam, we're looking for projections to the upside to find reversals at. All right. So then we're looking for SMT at those spots. All right. So let's look right here. So on Tuesday here, we leave SMT here at the lows because you can see the low on the NASDAQ here was at 11 a.m. You can clearly see the ES did not make a lower low here at 11 a.m. Okay, so right here was our SMT. We're projecting to the upside, all right? And 3.5 to 4 standard deviations right here. We trade into it, cap the range, okay? We're looking for these key things, okay, when we're bearish. But when we hit it, I didn't care for it here. We didn't have any sort of SMT right here, okay? But then as we continue to trade on, right here. Look at the ES. The ES, for one, moves above 4 standard deviations again here, but then it reaches up into this wick. Okay? Why is that significant that the NASDAQ didn't do that and the ES did? Wicks are gaps. Okay? So right there, the ES traded up into this gap while the NQ failed to do so. All right. And then you can see that just unfolded the smart money reversal. And you can see right here, we had the breaker. We closed below, came back up, retested, continued lower. Because then once we have a breaker, we have what? A valid projection. All right. And also notice, where was all of this taking place? Above midnight price. Okay. So right here, once again, we're projecting the daily range. We're projecting that manipulation of midnight price. And you can see we move down. What happens at 2 to 2.5 standard deviations? Reaccumulation. If we just rip straight through the 2 to 2.5, that is when we are extremely one-sided, and you will just see us likely expand right to the 3.5 to 4. Okay. And like I said before, that's when I'm not really interested. I'm interested in these moves right here. They are very calculated and predictable. So right here on the reaccumulation, what's happening here? We're just trading into the breaker, another bearish breaker here. Because if I zoomed out on the higher time frame here and was looking at Wednesday's price action, this right here is just a breaker to me, because we have a high, a low, a higher high, and then we displace below the low. Okay, so right here, I'm looking at this as the swing, and you can see, reject the breaker again, continue down to 3.5 to 4 standard deviations. And then you can also see we had a fair value gap here as well. So there's many things to be able to catch these trades, okay? And if you can catch that reaccumulation, these are the best trades. And then you can see, once we traded into 3.5 to 4 standard deviations, what do we do for the rest of the day? Not shit. We just consolidated. All right. It's not random that we're moving this accurately to 2 to 2.5 and 3.5 to 4 standard deviations. It's not random. All right. So here I thought it would be good to go into some live examples from trades I've taken and show you the recordings and just break them down of exactly what was happening. Okay. So here, this day in specific, this was a little different. Okay. So don't be mad if you can't really understand this one just yet, because this one takes some time to understand. Just focus on catching that reaccumulation move at first, like I was talking about. But here, so we had the manipulation of midnight price here. All right, we moved down 3.5 to 4 standard deviations. But what is happening here at the lows? Nothing. Okay, there's no SMT. No SMT, no real reversal. No SMT, no real lows. Okay? No SMT, no expansion. All right? You get it. We're not going to expand without SMT. We need all of these things I require for the setup for a reason. All right? And without SMT here at the lows, I was still bearish. All right? And I was talking about this in the Discord. There was no reason to be bullish yet without any SMT. All right? And right here, actually, we were seeing SMT because this high here on the NQ, the ES was above, as well as right here. Look, the ES is failing to make that higher high as the NQ did. So then we displaced down, created the bearish breaker. And then once again, we're still in sync here. So I'm still bearish. There was nothing supporting an upside idea. So I go short, one contract here inside the breaker. And once again, once we have a breaker, we have a projection, and 2 to 2.5 was lining up right at the low of day. And keep in mind, we already traded to 3.5 to 4 from the manipulation of midnight price. So I'm not anticipating a huge expansion below the lows. Okay. So if we get to the lows here and NQ is taking the low and ES is not, right there, we're seeing some sort of SMT. So I'm going to get out of the position here at 2 to 2.5, anticipating that to be capping the range. Okay. Then you can see we move down 2 to 2.5 standard deviations, and then ES is not taking the low. Okay, so right there, that's why I exit that and take profits there at 2 to 2.5. There's no reason to be greedy, especially if you look at actually how many points that trade was. It's 130 points to there. So that is more than enough. All right, this example right here, I want you to focus up, especially if you're new, because this is exactly what you should be looking for in how to trade it. All right, so once again, right here, we had our manipulation of midnight price. We moved down 3.5 to 4 standard deviations, capped the low. Okay, so then from here, we flipped bullish. Okay, and we're taking buy side liquidity here into 2 to 2.5 standard deviations. Okay, so we're anticipating reaccumulation here. So here I was talking about the DXY looks like it wants to expand up into this buy side. Okay, so when we're expecting the DXY to expand to the upside, we want to see bearish pressure across the indexes. Okay, and that's what we are seeing here. So we're trading up into 2 to 2.5, taking out buy side liquidity. We're seeing SMT. Okay, and the DXY is ready to expand higher. So this is all lining up for a reversal here. And it could just be a retrace for reaccumulation at an old low. All right. So right here, we can play this reaccumulation move because we know we at least want to go to an internal liquidity pool. And right here, I go short off the 50% of this wick because this was the key level here. Because once again, wicks are gaps. We rejected the 50% of that gap and started to continue lower here. And then you can see once we flipped over, we have our 1 minute projection here. 2 to 2.5 is lining up right at where? The internal low, like I just talked about, midnight price and this sell side. Okay. So many things lining up here with the standard deviation. And on the reaccumulation, we know we are at 2 to 2.5 from the bigger picture. So if we are expecting reaccumulation here, there is no reason to be holding this for a home run. You should be selling at that internal liquidity pool and 2 to 2.5 standard deviations. Do not get greedy. Your exits and entries come from key spots within the standard deviation. And even if you do anticipate us to go to 3.5 to 4, you need to be already having your stop loss in profit and taking a partial at 2 to 2.5. Okay. That is how you manage it. And then you can see right here, we ended up not hitting that last sell side target. And that's why I trailed my stop loss here, because once we're this far in profits, there's no reason to be risking it all the way back up to our entry. Okay. Because you can see right here, this is 70 points in profit. I'm holding it at this high or the sell side liquidity. I wasn't being that greedy because why? We're hitting 2 to 2.5 standard deviations. We are taking out this internal low here and manipulating below midnight price. Okay. So we didn't need to go below that low. I did anticipate us to, but we didn't. And that's fine. I got stopped in profits there. I'm not complaining. All right. Right here. This is going to be a good one because I had some DMs about this one day. So the NQ left equal highs right here, and everyone and their mom was talking about the equal highs. They wanted to see the NQ trade up into the equal highs. How did I know we were not going to trade into the equal highs here? Well, let's look right here. We have the manipulation of midnight price. We traded up 3.5 to 4 standard deviations. Okay. So we're capping the range up here. All right. And as the NQ left equal highs right here, the ES was coming up short. So we're seeing SMT there. And then we see a second SMT right here as the ES makes another higher high. Okay. And the NQ was failing to do that. Okay. So as the NQ is failing to make that higher high, it's trading into this order block here. So right there, I was going short off this order block, anticipating these equal highs to stay because we had already traded into 3.5 to 4 standard deviations to the upside. We're anticipating the range to be capping. So I was not looking for long positions. I was looking for shorts. And then once it all aligned, okay, because you can see we traded above the 4-hour open, above midnight price right there. Boom. Distribute down 2 to 2.5 standard deviations from the breaker here, okay? And you can also be putting a projection right here to project this 4-hour candle, okay? All right. This is another example you want to pay attention because there's some key signatures here that you're going to learn. Okay. So in this example, we're trading up into 3.5 to 4 standard deviations. Okay. So I am anticipating us to form a bearish setup up here. I'm not looking for a bullish setup once we're hitting that 3.5 to 4 standard deviations. Okay. I'm waiting for the SMT to actually confirm it the other way. And then right here. So look at this. The NQ is making a higher high. The ES is failing to make this higher high. And as that happens, notice we're above midnight price. We're above the 4-hour open. So right here, once again, we have the 50% of this wick. All right, that's our PDA right here. Very key, as wicks are gaps. Okay, so I go short right here off the 50%. And then once we flip over here and form the breaker, well, I was already putting the projection here because I could see the breaker form before it formed. And just wait for it, right down to 2 to 2.5 standard deviations. And right there, we take a partial at 2 to 2.5. If you are expecting 3.5 to 4, it don't matter. Take a partial. Don't be greedy, because right here, you're going to see how I was greedy. Okay. So just waiting. We get the move down. So right here, we came like 1 to 2 ticks from 3.5 to 4 standard deviations. And I did not take it off here. And we came back up and hit my stop loss in profit. Okay. So what happened here? Why did we not reach for 3.5 to 4 standard deviations? Well, look at the low here. You don't always want to be greedy. If we're coming off by a few ticks and we're seeing SMT, you just need to bail on the position. Okay. I don't know. I just didn't see it here. I guess I wasn't at the desk. Okay. So right there, we're seeing that SMT confirming the reversal at the bottom. So right here would have been fine to take it off, even though we came up a few ticks short. Okay. I hope you can understand that, because SMT and standard deviations, they go hand in hand. All right, so I really hope you're starting to see what I'm seeing within price. Right here, this is going to be the last example. It's a very good example. Pay attention, okay? So right here, the bigger picture, the manipulation of midnight price here, okay? We're looking at this projection to the downside. We have 2 to 2.5 and then 3.5 to 4 resting right below sell side, okay? So right here, we're getting the reaccumulation move before we hit sell side and 3.5 to 4 standard deviations. Okay, so this is a perfect example of when you can still expect that move lower. All right, because we're also not seeing SMT because the ES is leaving equal lows here and not taking out that sell side that's here with the NASDAQ as well. So right here on the reaccumulation, we traded up into 2 to 2.5 standard deviations. So this was capped up here. This was a valid high. We did not anticipate price to come back above it. So right here in this breaker, very valid entry, because notice time right into the new 4-hour candle. Okay, these time openings and where they're at within the market maker model are not random. Okay, they waited till right here for the 4-hour open for a reason, because then they give the manipulation above the 4-hour open to create the wick, okay, to then distribute it lower down to 3.5 to 4 of the bigger picture. Okay, so this is exactly what I'm talking about, how a power of 3 can finish, but we have not finished that market maker model. So then that next power of 3 will carry over and finish that market maker model. And then you can see we went all the way down to that 3.5 to 4 standard deviations. Okay, so I really hope you're starting to see exactly what I'm seeing here within price. It is happening every day. This stuff is so accurate. It's not random. We're moving 2 to 2.5 and 3.5 to 4 standard deviations every day. All right, the market is ran on an algorithm. It is very precise and accurate, and that is why you're here watching this video, because you have seen me execute the market to a T, okay? And after this video, I know there are going to be more of you doing it just like me, okay? So, all right, and before we end the video here, I just thought I'd show you, Here is that breaker video I was talking about, how I interpret breakers. This will greatly help you with where to project off of, as well as how I identify explosive moves and catching the distribution in price. Okay. These videos and 4 hour power of three, a deeper dive. Okay. These will help you in choosing when to trade, because not every, okay, if you like trading the 4 hour power of three, for example, not every 4 hour candle is going to be a distribution candle. Okay. There's times when there's flat 4 hour candles. Okay. So you got to know when we should be expanding and expect that distribution. Okay. So watch those other videos to determine how I determine that stuff, as well as I do have a paid group. If you're interested in that, we go way deeper into this theory and more, but this is the end. But I hope you got something from this video. Put a lot into it. I made sure to make it good. Be sure to share examples with me. Tag me on Twitter. Show me your trade reviews. I want to see them. Okay. Let me know your progress within this theory, because your eyes are going to be opened if you take a deeper dive into it. Okay. So have a good one, and I will be talking to you again very soon.